Let's have a look at the trading setup first. The strategy buys when the current closing price on daily time frame closes below the previous 7-day low and the market is above its 200-day moving average. That's it. Only two rules to buy. On this chart of E-mini S&P 500, market closed below its previous 7-day low on this particular day. The 7-day low is plotted on the chart by the turquoise line with the 200-day moving average shown in yellow. I've taken this strategy from a book called Short-Term Strategies That Work by Larry Connors. Highly recommended for anyone interested in algorithmic trading. Trade is then closed when the market closes above its previous 7-day high, i.e. the opposite logic. Again, the 7-day high is also plotted on the chart in turquoise line. Market broke above it on this day, generating an exit signal. That's it. Those are the all trading rules of this strategy. The actual code that I wrote in AmiBroker is shown on the screen. Two entry rules, as I've just described them, are here. The sell rule is here. I'm using stop loss of a size equal to twice the average true range of past 20 bars. This ensures that the size of the stop loss takes the current volatility into the account and is my preferred way of using stop losses. Now let's have a look at the results. I've tested the period from beginning of 2007 up to the beginning of October 2020. Trading commissions are included and the trades are opened and closed at open rather than close. Starting capital of 10,000 with 4 different ETFs traded, which is SPY, TLT, GLD and VNQ. These ETFs are picked to achieve enough diversification as they all cover different markets, namely equities, treasury notes, gold and real estate. System holds 4 maximum positions at a time, where it splits the capital equal into 4 parts. 50% margin is used in the backtest as well. Average annual return of 7.5% with associated maximum drawdown just under 10%. Sharp ratio of 0.7. The important thing, however, is the fact that the strategy's exposure is only 20%. What this means is that the strategy had trade open only in about 20% of total time that it was tested on. Taking the annual return figure and putting it into context of this exposure, the annual return figure is actually very solid. Annual return adjusted by the 20% exposure arrives at 37%. The total number of trades that this strategy made is 360. Now bear in mind that I tested a period starting from January 2007 up to beginning of October 2020, which is almost 14 years. Now this translates to only around 25 to 26 trades per year to achieve an average annual return of 7.5%. Now, many people would have scrapped this strategy because the return is too low. This is, in my opinion and experience, a big mistake. This is a common mistake among beginners who look for strategies with extremely high returns that obviously go hand in hand with high drawdowns. I discuss this in more detail in my free ebook where I talk about how to avoid typical mistakes that beginner traders make, and I also give you a recommended portfolio of markets to start trading depending on your initial capital. Download it for free, click the link on the screen or in the comments section. Now, going back to the strategy, as I said, this is a very passive, low exposure strategy that can be easily combined with other strategies to boost its performance. When looking at the absolute annual return figure, you need to take this into the account. If you have a strategy like this that's only invested in a market 20% of the time and produces 7.5% return, then obviously it's better than the strategy that produces 12% return but it's invested 80% of the time. On top of this, its performance can be further improved by trading futures instead of ETFs, which is what I'm going to show you in just a second. Strategy's equity curve looks solid, so does its monthly profit distributions. Strategy passed the Monte Carlo analysis as well, which is good. But now, what if we take this strategy and simply apply it to futures instead of ETFs? The obvious reason for doing so is to increase the performance as futures come with much higher leverage. I've tested this by applying this strategy on micro S&P 500, micro gold and 2-year T-notes. I've simulated starting with a capital of $10,000 using the same stop-loss calculation. The position size, however, is calculated slightly differently. This is because we work in the futures, not stocks or ETFs. Position size is based on maximum 5% risk of equity. The starting equity is 10,000, so 5% of this is $500. Then the required size of stop loss is calculated based on 2 times the average true range of 20 bars. If this value arrives at $500 in monetary terms, one futures contract is traded. If it arrives at $250, then strategy opens 2 contracts. And the final equity curve looks as follows. The total profit quadrupled. It went from 17k to 74k. Obviously, the maximum drawdown increased as well, which is logical as we're working with higher leverage when trading futures. The average annual return is now at almost 17%, and this is despite the fact that a strategy is now applied only on 3 markets, as opposed to 4 when using ETFs. The profit table looks much more interesting as well, with 2019 showing over 40% return. Once again, keep in mind that this is a low exposure strategy with very low frequency of signals. Due to this, I wouldn't recommend to go and start trading it in its current form on its own, but rather use it as a great supplementary strategy. The key thing I wanted to demonstrate in this video was how can a performance of a trading strategy be improved without resorting to changing its rules and making it unnecessarily complex. Doing so increases the risk of the strategy being over-optimized, and I personally don't do it myself at all. Instead, what works for me very well is investing time into risk management elements of the strategy, combining it with other strategies, or simply using different markets as demonstrated in this video. Thanks for watching. David from Critical Trading, signing out.